Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, March 10th, 2026. So last week when we did the podcast, we knew at that point, of course, that the U.S. and Israel had attacked Iran, causing disruptions in the market, but we simply recapped what had happened the week before because we knew this week we'd spend a little time on it. So we'll talk about it tangentially, not really from the political side or what might happen with the war, but simply the impact that it's had in the markets and might have going forward. So to begin with, the biggest issue, besides loss of life, of course, and all that, but the biggest issue for the markets is inflation and what this might mean for oil supply, oil prices. So inflation in the U.S. has been manageable, a little higher than hoped for, definitely higher than the Federal Reserve has targeted, which is 2.0 for personal consumption expenditure. So any increase, an expectation of increase for inflation is not a good thing for the market. So last week, we'll go through the numbers. The markets were definitely down in the U.S., both fixed income and equities and as well international equities. But first, we'll just take a look here, which is what's happened to oil prices just in the last week. Since the Iran has been hit a week and a half ago now, but the 5 days here, what has happened to oil prices? Huge increase. Last week, 35% increase in WTI per barrel. So that's the highest on record before in 1983. There aren't good records, I guess, for futures markets. Nonetheless, an extreme uptick in oil prices, which of course has definitely hit the markets because of the concern about supply of oil going forward and what that does to prices. So what happened last week with inflation expectations, probably should use a shorter chart here because you can hardly tell, but it's actually up fairly significantly. So the 10-year expectation for inflation, the 10-year minus the tips, is actually went up 10 basis points from 2.25 to 2.35. That's the expectation for average inflation over the next 10 years. So that's kind of a significant 1 week increase. Now, we have no prediction on how long this is going to last in the Middle East or any guesses on outcome. We'll simply say that it has historically not been a good idea to adjust your portfolio, de-risk your portfolio because of political, or I should say, armed conflict for the United States. So we have a chart here that goes back all the way to World War II and shows what happens with the markets 3 months after, a year after, 3 years after. And the takeaway is every three-year period after each incursion, each event has happened, the market has been up over that time frame. Now, the worst was probably the U.S. oil embargo back in 1973, with just a very tepid increase over the 3 years in terms of how equity markets performed. But the takeaway here is really overreacting or pulling equity out of the market because of an armed conflict with the U.S., generally speaking, has not really paid off. In terms of what has happened with this conflict last week and expectations of future growth, the Atlanta Federal Reserve did take down their estimate for first quarter GDP in the U.S., so they had been at 3% the week before. They brought that down to 2.1%, not 2.1% by itself. That would be a very solid quarter. Last quarter, fourth quarter of 2025, was disappointing from a GDP standpoint. It was a positive 1.4%, but for the total 2025 year, it was 2.5%. So 2.1% GDP growth in this quarter, if that's what it turns out to be, would be a pretty solid quarter. In terms of Fed funds and impact, the inflation impact and what expectations are for future Fed cuts, we have a Fed meeting next week on Wednesday. A rate decision will be announced, and there's virtually no probability of a rate cut at that point. Something could happen, but very unlikely that we'll get a rate cut. But when we look to December and look at the expectations, so by December, the embedded expectation is One rate cut, only 22% probability of that happening. Two rate cuts, 72% probability of that occurring between now and December, and three cuts, 38% odds. Those are significant because the Federal Reserve has conditioned us or told us that we should expect one rate cut this year. We'll see if that is updated by Chairman Powell next week during the rate decision, but Powell's tenure with the chair as chair of the Federal Reserve is over in May, I believe, so very unlikely he's going to do anything that really rocks the boat. So in terms of economic activity that was released last week, we'll go through these quickly. There aren't that many that really move the market, but unemployment, we had mixed signals and very mixed. On Wednesday, the ADP survey, employment survey, much smaller survey than the BLS uses that we'll be citing from the numbers on Friday, the non-farm payroll results. But the ADP employment change was better than expected. 65,000 new jobs. Expectation was only 50,000. Then on Thursday, jobless claims came in again better than expected or feared. Expectation was 216,000. It came in at 213,000. But then on Friday, we got a real bolt, seemingly out of nowhere, but this was a definitely not an expected outcome. The consensus for new jobs created in the month of February was 60,000. It came in at a negative 92,000. So huge number, and we'll just see what those implications are and if we get greater clarity on exactly what drove that. But certainly a negative surprise on the employment front. We also got retail sales, the January retail sales numbers, it's month over month. It was as expected. It was negative 0.2, simply meaning January was weaker than December, not surprising. The unemployment rate with that payroll number that we mentioned, unemployment rate actually did rise from 4.3 to 4.4%. Average hourly earnings, though, went the other way, positive. Expectation for February, positive 0.3%. It came in positive 0.4%. So the markets did not react well to all of that news last week, but I would have to say much better than I certainly would have feared. S&P 500 down about 2% last week. The equal-weighted S&P 500 that we've talked about the fact that that has outperformed, largely because the Mag 7 has rolled over. That relationship changed last week. So the equal-weighted S&P 500 last week down about 3.4%. And the other two factors that we often mention that really turned around last week, value underperformed growth and small cap underperformed large cap. Now, year-to-date basis, still value has almost a 7% lead over growth, and small cap likewise has over a 4% lead over large, but those advantages definitely decreased with last week's trading. International markets got hit much worse than the U.S. market. Developed markets ex-U.S. down 6.3%, and emerging markets down almost 7%. Now, both of those indexes are year-to-date better than the S&P 500, which is down a little bit. Developed markets ex-U.S. up almost 3%. Emerging markets up almost 7% still year-to-date, but their leads over the U.S. slashed dramatically last week. Fixed income also down last week. We had the 2-year yield up 17 basis points, the 10-year yield up 18 basis points. So the Bloomberg U.S. Aggregate Bond Index down almost 1%. And if you were unfortunate enough to be in long-term U.S. Treasuries, with that 10-year going up 18 basis points, that index was down 2.1%. So economic activity, that will be released this week. The ones that really matter, Wednesday will be big. We'll have the PCI inflation numbers, CPI numbers, I should say, the core and the base number. So the headline number month over month for the month of February is expected to be up 2.2%, same as we saw in January. Core also expected to be up only 0.2. It was up 0.3 in January. So this will be interesting because we've seen pressure on the producer price index. And it'll be a little bit surprising if the CPI, if the PCI core actually does decrease from the prior month. But we'll see. Thursday, we will have initial jobless claims. Now, the expectation is 215,000. Last week was 213. Big day on Friday. So we will get PCE, and that personal consumption expenditure, which is what the Fed really focuses on. So the core PCE in particular for January is expected to be up 0.4% month over month. That's a huge increase. That's also what we saw in December. We'll also get the durable goods number for January. That was really weak in December, negative 1.4%. Expected to be a positive 1.2% for the month of January. We will get the second estimate for the fourth quarter GDP. Usually there's not much movement. As we mentioned, it was reported at 1.4%. That's expected. That's where it'll probably come in. We'll also have personal income for the month of January. Personal income for the month of December was up 0.3. It's actually expected to have improved to 0.4% for the month of January. And then lastly, personal spending, expected to be a little off from what we saw. December was very strong, positive 0.4%. For the month of January, it's expected to be a positive 0.2%. So that's it for Economic Wrap-Up. We thank you very much for your attendance. We look forward to seeing you next week. Thank you.